Hello everyone, my name is Sethi. I hope you all are staying healthy. Today we are going to talk about theories of term structure of investment. First theory is expectancy theory. According to this theory, long-term interest rate is just average of short-term interest rate. According to this theory, long-term interest rate is average of short-term interest rate. That means long-term interest rate influenced by short-term interest rate. But why? Because long-term interest rate depend on expectation of people. If people expect in future interest rate increase, then interest rate increase. But if they expect in future interest rate fall, then interest rate fall. This theory assumes investors are indifferent. That means they don't worry about investment style. For example, they don't analyze so much whether to invest in 1 year bond, 2 year bond or 3 year bond, as long as final return on all these investment is the same. So according to this theory, most of people think in future interest rate increase, then interest rate will increase in order to match with expectation of people. For example, you have two investment offer, either to invest in 1 year bond or invest in 2 year bond. Currently, market is offering you 5% interest rate on 1 year bond, but you expect in future interest rate will increase to 7%. Average of 5 and 7% is 6%. You will only invest on 2 year bond if market will offer you 6% interest rate. Otherwise, you will just invest on 1 year bond. Obviously, next year you expect interest rate will increase to 7%. Then why should you invest on 2 year bond? You will just invest on 1 year bond. In next year, when interest rate increase, you can again invest on one more 1 year bond. So, according to this theory, market should offer higher rate of interest if they want. People should invest more in long-term bonds. That means the market should raise interest rate according to expectation of people. Next is liquidity preference theory. According to this theory, people prefer their liquidity. People prefer their cash. That means people like to hold cash. And people want to hold cash mainly for three motives. Transaction motive for day-to-day expenses, precautionary motive means emergency purpose, accident, disease, and third motive is speculative motive. They want to hold money so that in future they can invest if they find any investment opportunity, good investment opportunity. So, if people prefer to hold money, that's why they think locking money for 10 years is more risky as compared to locking money for just 1 year. Obviously, if in between they need cash due to inflation or due to emergency purpose, then what they will do? That's why according to this theory, people prefer their liquidity, people prefer their cash, they want to hold their money as a cash. So according to this theory, people like their cash so much, people prefer liquidity, they want to hold their money as a cash. If market want people invest their money on bonds, then market should offer them liquidity premium. That means market should provide them extra bonus. For example, if your friend promise he will return your money within 1 week, then you will just charge 1% interest rate. But if he say I will return your money after 10 years, then you will charge 8% interest rate. Remaining means extra 7% interest rate is your reward for waiting. Similar, if market want people should invest their money in bonds, then they should offer higher interest rate on long-term bonds and lower interest rate on short-term bonds, because people think locking money for 10 years is more risky as compared to locking money for just 1 year. Next is market segmentation theory. According to this theory, there is no big market for loans. Market is divided into two segments: short-term loan segment and long-term loan segment, and these market don't affect each other because interest rate influenced by demand and supply of loans within a specific segment. For example, if in short-term segment demand for loan is more but supply is less, then interest rate will increase. Similar, in case of long-term segment, if demand is less but supply is more, then interest rate will fall. These interest rates are influenced by demand and supply within the segment. These two markets don't influence each other. And short-term loans means short-term to medium-term loans provided by commercial bank. That's why commercial bank is example of short-term segment. On the other hand, pension funds and insurance companies provide long-term loans. That's why these are example of long-term segment. Short-term market segment where mostly people prefer to save their money just for 6 months. There are high supply of lenders as compared to demand. That's why interest rates stay low. In case of long-term market, people provide loans for a long time period, for example, 20 years. But there is a less supply of lender as compared to demand. Obviously, people don't want to lock their money for long time period. There is less supply of lender as compared to demand. That's why interest rate stay high in case of long-term market segment. Next is preferred habitat theory. This theory is combination of market segmentation and liquidity preference theory. According to this theory, every investor have one preferred area. For example, some want to invest for short time period, so their preferred area short run. On the other hand, some want to invest for long time period, so their preferred area is long run. Most important thing, investor can leave their preferred area if you offer them higher return. For example, your preferred area is short run, you just want to invest for 1 year at 5% interest rate. If bank increase 6% interest rate for long term preferred area, then obviously you are not ready to leave your short run preferred area. But if for long term preferred area bank offer you 9% interest rate, then you are ready to leave your short run preferred area. So according to this theory, investor have their own preferred area, but they can leave their preferred area if bank offer them higher rate of return. So according to this theory, every investor have their preferred area, or you can say the natural home where they feel safe. For a retired person, prefer area is a short time period, for example 1 year, because they think any time they need cash for their medical needs. On the other hand, for a pension fund, prefer area can be long term 20-year bonds, so that pay out from future pension. According to market segmentation theory, people cannot leave their habitat. That means people cannot leave their specific segment. But according to this theory, people can move from their preferred area if they are pay enough. For example, if long-term bonds offer much higher return as compared to short-term bonds, then people can shift from short-term loan to long-term loan because they are more profitable. This theory also talks about terms premium. What do you mean by terms premium? If you want investor leave their preferred habitat, or you can say that if you want investor leave their preferred area and ready to take more risk, then you must offer them extra incentive. This extra incentive will be called terms premium, or you can say the risk premium. Now we will see one simple example. For example, your preferred habitat is 2 years. You just want to invest for 2 years, because after 2 years you are going to buy one car, and you want to invest at 2 years bond which offer you 5% interest rate. Now suppose bank offer you 10-year bond with 5.5% interest rate. You were already receiving 5% interest rate on 2 years preferred area. Extra 0.5% is not worth for you, because you have risk for locking your money for extra 8 years. So you will not ready to leave your preferred area. But if bank offer you 10-year bond with 10% interest rate, then extra 5% is worth for you. Now you are ready to leave your preferred area, which was 2 years investment, and try to manage your cash. So this is all about today's video. I think you got it, and thank you so much for watching this video. Bye, take care.